Okay. Good morning, still. I'll repeat a little bit of what I've done, what I've told you 2 days ago in the panel. And then we'll continue and we'll see how much time we'll have to cover the issue of Black-Scholes Merton model, VIX, evolution of risk management, few topics put together. So I'll talk about some personal notes. We'll skip the decomposing risk. We'll go to the VIX. And if you'll have time, there's an interesting case study, if you recall, on August 5th, 24. Very interesting as far as the VIX is concerned. It was a sort of inside the day that something happened. But let's go first of all a few words about Black-Scholes. There were a few papers, not many, before Black-Scholes in 1973 for the young generation. And actually, if you look at the paper by Bones, that was written in 1962, it was a dissertation at the University of Chicago, published in the Journal of Finance, and you'll find identically the Black-Scholes formula. So the Black-Scholes formula was already published, almost this Black-Scholes formula, I should say, was published 10 years earlier. And he made the same assumption, log normal distribution, and he looked at the expected future value and discounted it, risk neutrality assumption. There's a slight difference between Bones and Black-Scholes, and that's the definition of R, the riskless interest rate, which appears in Black-Scholes. In Bones' paper, it's not the riskless. It's the expected rate of return on the underlying equity, because they assumed risk neutrality. So assume that all discount rates are the same as the expected rate of return on the corporation, on the firm, on the underlying stock. So there's a slight difference, but it's huge difference when you do the valuation. It can be for at the money options for 6 months. It can be tens of percent apart when you introduce 5% or if you put 10%. But it's interesting to see the evolution. In any case, in my dissertation, when I mentioned Bones and that they have similar formula, Black-Scholes asked me to delete it. They didn't want any mention. So you'll hear some historical anecdote. Okay. So my personal perspective, as I mentioned, I finished my dissertation in 1975 under the guidance also of Black-Scholes, Mert Miller. Very nice. Some of them got the Nobel Prize from the dissertation committee. Fisher Black unfortunately died 2 years before they were awarded the Nobel Prize at a young age. In August 75, I did some consulting work for the CBOE, the Chicago Board Options Exchange, that was just established 2 years earlier. And it culminated in a paper that appeared in the Journal of Finance. The referee was also Fisher Black. And it was an index, proposal for an index for traded call options. And the whole idea was about creating a synthetic call option. At that time, puts were just introduced, not much trading in puts. They were introduced in 75, actually the same time that I was consulting the CBOE. So it wasn't active trading. So I based it on call options, creating synthetic option, always 30 days, always at the money, by interpolating and using the right weights. But it was for the valuation of an option and to see the changes in the value of a call option. And switching each time a new series came in, and 30 days was the most convenient at the time because the options, again, for the young generation, the options at the time for quite a few years, more than 10 years, were only 3 months, 6 months, and 9 months. When the 3 months expired, they introduced another 9 months. So you didn't have all the maturities that you have today, all the series that you have today. So it was much more complicated. And remember that in the second maturity, trading was not very liquid. So the 30 days was convenient in this sense. Not perfect, but those were the constraints at the time. But funny enough, it stayed until today, the 30 days, as a convention. But the reason was really technical, the 3, 6, and 9 months. Okay, the idea was, we continued to work on the idea with my colleague Menachem Brenner, and in 85, 86, we wrote a few position papers, actually proposing to create an index based on implied volatility. We called it Sigma Index. We presented it to the American Stock Exchange in 86. The head of the new product committee was Bert Malkiel from Princeton. He was skeptical about it. I spoke to him many years later, several times about it. But he didn't expect it to be a successful product, and some of the traders didn't know how to hedge it. So actually they rejected. They didn't understand it. So we got permission from the American Stock Exchange, our good friends. We went to Chicago, presented it in July, just 3 months before the crash. They liked it, they liked the idea, but then came the crash of October 87. The market fell 22% in one day. And it was sort of put on ice. They froze it because they were too busy repairing the decline in volume in traditional options that they were trading. I had a very young assistant at the time who helped me in doing the simulation of the index. We got data from the American Stock Exchange. They had an index, IIM, the Institutional Investor Index, that they created based on 20 stocks. We got data because we had a lot of backing from the American Stock Exchange. As the other assistant is sitting here, Chaim Levy. He helped on doing the simulation, so we have live evidence about that everything I'm saying is true. Okay, so we presented also the simulation. They liked it, but as I said, they had a crash. Okay. At the same time, more or less, due to the crash, the city of Houston sued an analyst and sort of advisor that they had by the name of Kassouf, who wrote paper on options in the 60s of the last century, before Black and Scholes. And he advised the pension fund of the city of Houston about overwriting options. They had another trader, another advisor, managing a portfolio of $100 million. And this Kassouf got permission to write call options on the stocks in the portfolio. Okay, it's overwriting program. And he promised that he can make 1% additional profit. Now, mind you, and remember it, when you write call option, when you sell options, call options, you sell beta. And in call options, the embedded beta from a Sharp-Lintner, okay, can be easily 4 or 5. And when you sell it, you are -4, -5. So if you look at the market line and you are -4, -5, what is the expected rate of return? Should be negative, should be below the riskless. So how can you promise an extra 1%? Okay, so again, we are going back to 87 before the crash. The market was going up. And when you sell call options, you're losing money on the portfolio of call options because you don't manage the underlying. The underlying were making money, but the overwriting is losing money. So anyway, the guys that were managing this portfolio lost money. They didn't go to the fund to tell them we are losing money. They were trying to cover it up by writing deeper in the money options and then index options. It was a whole affair, yada, yada, yada. At the end of the day, they lost about $15 million. And when the crash came and they could have recovered all the losses, they were out of the game. They were rethinking about the program. So they never recuperated the losses. And the city sued them. Okay, why I'm telling you? Because I had a colleague by the name of Bob Whaley, with whom I worked as expert witnesses in this case. I was asked to write an opinion about the case of overwriting, whether you can make the extra 1%. But my colleague and friend at that time, Bob Whaley, we worked together, and I told him about what we did with the proposal to the exchanges on having implied volatility index. He had the access to data on the S&P 100, which was the underlying index at the time. Not the 500, they had the special 100, narrow one. He promised me the data, promised. Each time a different excuse. And one day I get an announcement from the Wall Street Journal that the CBOE is working with Whaley on introducing an index, the VIX index. So I was asked to expand on the story, but the idea was obviously ours. As I said, I have a witness here with me. And yes, the rest is history. The exchange started publishing the index in 93, but they weren't trading it. It took another more than 10 years until 2004 when they started to trade futures. And 2 years later, from 2006, they start trading options. And today it's one of the best products they have on the CBOE. They made fortune trading this index. As I mentioned also 2 days ago, at the time, nobody was talking about having a patent on a product, financial product. So we never protected it. And it was already in the public domain because we published some papers. So that's the personal note. Okay. Historical notes about the new exchanges. It's important to understand. Actually, in 1944, there was a very important event in the global financial life markets. It was the Bretton Woods Agreement that fixed exchange rates. And actually, from the 40s, from 44 on, until the late 60s, beginning of 70s, all exchange rates were fixed, monitored by the World Bank and the IMF. Also, the interest rate policy was to fix interest rate and to change the money supply. Beginning of the 70s, Nixon became the president, right wing. Milton Friedman and his disciples took over Washington, DC, the government, and they started to have the philosophy embedded in the policies. So actually, the United States went off the gold base, $35 per ounce of gold. In 72, they got off the fixed exchange rate, and the whole world became very uncertain. All the uncertainty exploded in the 70s. Then came the oil embargo, et cetera, and also commodities started to go wild. And markets responded by creating new exchanges. And actually, the first one was the CBOE in 73. But within 10 years, you had more than 100 new exchanges for options, futures, and then the options were so successful, they took over the stock market. It happened in Sweden and many other countries, where the options became sort of dominant over the equities that were old, traditional, some had 200 years experience, but not very dynamic. Okay, so it's all changed in the 70s, and the OTC market today is between $600 trillion to $700 trillion. The outstanding notional amount of future swaps, options on commodities, on foreign currencies, on equities. Actually, equity is a small part of the OTC. Most of the OTC is daily trading is in foreign currencies. Outstanding notional is in interest rates. But it's a huge, huge market. Also leading to trying to regulate banks on a global basis. And that's the Basel Committee, BIS, and we don't have much time to spend, but I can give you references. Okay. The volatility index. So the volatility index that we proposed in the early 80s was the following: always 30 days ahead, looking forward. And that's the uniqueness. By the way, if you look at all the indices in the world, the only index that is forward-looking based on actual data today is the VIX. Because if you ask people about sentiments, if you measure unemployment, if you measure GDP, all are retrospective, looking back. The only index, and that was the whole idea that we try to sell, not necessarily successfully initially, was that the only index based on data today that reflects the future. So it's 30 days ahead, estimate of the volatility risk, S&P 500 today. At the time it was S&P 100. They changed it later on in the 90s. Based on actual prices of options, so we don't invent any price. We use actual prices, but we raise them in such a way that they reflect the 30 days at the money options. And as I said, today that you have also weekly options, very active markets, you can change it and create indices for different dates. Nothing holding the 30 days. I can tell you there's nothing. It was a matter of convenience. And I think that today, 15 days will be much better from statistical point of view than the 30 days. Okay, so low measured volatility means that the cost of protection of insurance in the market is going down. And that's one way to interpret the VIX. So if the VIX, the 30 days ahead, is going down, it means that you can now buy insurance about your stock positions and it will be cheaper. Okay. So here you have an explanation what is a VIX from the Investopedia. Some of it is taken, you can find in the website of the CBOE. So our calculation, as I said, was based on interpolating the different options, actual prices of options that are very close to the money. We took only shares that were close to the money because they are the most liquid. There's a huge amount of trading. And when you have huge amount of trading and liquidity, it means that the error in estimation is much smaller. And the idea when you create an index is to reduce the noise because none of the indices is perfect. If you look at the Dow Jones, it's a terrible index. S&P, better, but not great. You know, they have all kinds of issues, statistical issues. For example, in the S&P, not all shares are being traded simultaneously. So they reflect data or information that can be stale, that can be late. But still, you take the last price. When you have a very liquid market, you have a much better reflection. Now, also remember, when you trade on an index, the stock market reflects the index before the index is actually adjusting itself. If there's any event, one transaction in options, you already reflect what people think should be the index. So if there's a bad event, something happened bad, Trump is imposing new tariffs. Okay, so he has a speech, He says, I love the word tariffs. We'll have tariffs of 50%. You can see it in the case study from August 24. Immediately during the day, the options reflect huge amount of uncertainty. It took the stocks much more time to get to the same index. Okay? So it's much better to do it this way. And by creating these synthetic options, you imply the interest rate. What Whaley did with the exchange, they took implied volatility from the different series of options, and then they did the averaging, weighted average, based on more volume, but then what we did to make it more accurate. But it's a good approximation anyway. It's a little slightly different calculation, but the correlation between the approaches is about 99%, 99.5. Now, what is important, as I said, that there will be not much noise, and the change in the level is what is important, not the absolute level, but the change from minute to minute, from day to day. By taking only the at-the-money options, you get rid of the smile effect. Options that are out of the money, they have a smile effect as far as volatility is concerned. So you neutralize it. And again, you reflect the best information in the marketplace. The alternative approach, I said, is one was suggested by Whaley, average of implied volatilities. Another one was suggested by Derman, that is formula-free. But again, all those approaches have more or less the same, very highly correlated. Okay, today you have many implied volatility indices proposed initially by the CBOE, but today also by other exchanges in Europe, in the United States. So you have for example, one that is pretty popular, the VXN, is on the Nasdaq 100. You have on the Russell and other indices. And also you have many more series of, as far as expiration days and striking prices. So today it's really you are spending quite a lot of for trading. Okay, some depictions. Here you have the VIX going for quite many years on a monthly basis from January 99, okay, last century, all the way to June 25. And you can see that actually it's volatile. Now, again, historical note. I had some of the information as a chapter in my dissertation, and I took it out because it was long enough. And you see there is some contradiction between using Black-Scholes and what we see here reflected by the Black-Scholes formula. Okay? Because what we see is that implied volatility is changing. Black-Scholes assume constant volatility. Okay, so there's contradiction between the assumption behind Black-Scholes and the evidence coming from the Black-Scholes, but it doesn't matter. If you make mistake and we make it consistent, then the changes are the important part of it. Okay, and you see here very familiar events. For example, what do we have here? In 2001, you see a spike. That's the 9/11.
Yeah, it's September 2001.
Okay, then you have another spike, 2008, September. What is that? The highest? That's Lehman Brothers. Okay, the collapse of Lehman Brothers. So you see it was the highest recorded. It came to more than 80%. And then it took quite a long time to go back. So we see that we have what we call mean reversal in volatility. They go back, but also when they go back, it's about to 12%, 15%. Sort of the normal range for volatilities is about 15% over a long period of time. When it hits 10, it's low, very low. When it hits 30, it's starting to be very high. And since it's mean reverting, it depends on your horizon. You can expect it, if it's high, that it will go down, and you can see it. Okay? And then we have here 2020, March. That's the COVID. Yes. And again, what do we see here in 25?
US elections. US elections.
No, Trump, I love this word about the tariffs, the announcement of the tariffs. It introduced, the one speech introduced huge amount of uncertainty. And if you recall the events, one day he said, I love this word, 50%. Then he said, no, we'll start negotiating, maybe it will be 15%. And again, the day later, I'll punish the world, for taking words from the United States. So it's amazing how sensitive it is in reflecting the sentiments in the marketplace. So here you have a different approach that's from the lab of Bob Engel, who got the Nobel Prize for Arch Gauge, and that's his estimation of volatility. And again, it's the United States and the European one. And it's a somewhat different, it's not the implied, but the actual volatility based on a gauge estimation. Okay, I highlighted here the period of from February 25 to August 25, but again, what I circled here is the Trump tariff policy. So introduce a lot of volatility. One speech, one act by the United States introduced huge amount of volatility that is only now sort of being mitigated. Once many of the tariffs are already sort of in place, so we can see here the changes, and now it's 14.8, which is just in the middle, sort of normal. Again, we got back to some normal levels of volatility. Okay, term structure. Since we have many series also going into the future more than 1 year ahead, we can measure the implied volatility for different maturities. So that's important. It conveys quite a lot of information, not about volatility today only, but also how it's reflected in the future. And over the last few years, it's upward sloping, not always. There were periods that it was downward sloping. By the way, it was very interesting to watch it around the change of the century when people didn't know what will happen on December 31st, going into January 1, 2000. With computers, everybody was worried about what will happen to the computers, whether you will be able to withdraw money from ATMs. There was a lot of concern about it. And then actually you saw that the term structure was going down up to the beginning of the century, and then already reflected in the option market, a decline in volatility going to January, February, etc. Again, from different dates, also to the term structure. And you can see that if the short run here is something like 26, which was high in September 19, it's something like 2-3% increase over time. Okay, so behavior of the VIX, and I'll stop here. We have inverse relationship between the stock market level and volatility. Usually when the stock is going up, volatility is going down. And again, the correlation is not -1, but it's still negative correlation between the stock market. So some people try to hedge changes in the stock market with the volatility index. And there are many uses of, we don't have time to spend on it. And the second behavior phenomenon is mean reverting that I mentioned before. So thank you, and you can download the presentation and you'll find a little bit more evidence about it. Thank you very much.
Thank you.